Guys, today a major piece of data just flicked in a way that lines up perfectly with the biggest macro setup this market has seen in years. If you're holding XRP or paying attention to crypto at all, this is the kind of development that could separate the people who get shaken out from the ones who look back and realize they were positioned exactly right. Stick with me here, because what dropped this morning isn't just another number. It's the kind of quiet catalyst that changes everything over time. Let me pause right here and say this clearly. I am not a financial advisor. I have no professional credentials in finance or investing. Nothing I share in this video is financial advice. I'm just a passionate enthusiast who loves digging deep into crypto news, macro trends, on-chain activity, and XRP developments. Always do your own research, think critically, and only make decisions you're comfortable with. I'm simply excited to break down what happened today because it feels like a real turning point worth unpacking in detail. Okay, let's dive in. This morning, the Institute for Supply Management dropped their January manufacturing PMI report, and the headline reading came in at 52.6%. That is a huge jump from the previous month's 47.9%. And it completely smashed what anyone was expecting. Most forecasts hovered around 48.5%. But the number itself isn't even the full story. The real game changer is that this pushes the index above 50 for the first time in over 3 years. Since late 2022, we've been stuck in the longest manufacturing contraction on record, watching that line stay below 50 while the broader economy wrestled with high interest rates, supply chain hangovers, inflation pressures, and all the lingering effects from the pandemic era. 3 full years of grinding through contraction, wondering when the turnaround would finally show up. And today, it did, not with a whimper, but with a decisive surge that caught pretty much everyone off guard. To make sure we're all on the same page, let's talk about what this PMI actually measures, because it's one of the most respected leading indicators in economics. Every month, the Institute for Supply Management surveys hundreds of purchasing managers from manufacturing companies across the country. These were the people on the front lines, the ones deciding whether to order more materials, ramp up production lines, hire additional workers, or pull back because demand looks weak. They answer questions about new orders, production output, employment trends, supplier delivery times, and inventory levels. All those responses get compiled into a single diffusion index. Below 50 means more managers are reporting contraction than expansion. Above 50 means the opposite. More are seeing growth. It's not based on guesses or models. It's direct, real-time feedback from the heart of the industrial economy. And today's report wasn't just barely above 50. It was convincingly in expansion territory, with key subcomponents like new orders showing particular strength. New orders are especially important because they're a leading signal. If companies are getting more incoming business, that's usually the first sign that production, hiring, and investment will follow. When you see that kind of momentum building after such a long downturn, it tells you something fundamental is shifting in the economic environment. So why does a manufacturing survey matter at all to something as seemingly disconnected as cryptocurrency? Because manufacturing doesn't operate in a vacuum. It's deeply intertwined with global liquidity, the amount of money flowing through the system, and how easily businesses and governments can access capital. When purchasing managers report expansion, it means they're confident enough to commit to growth. That confidence typically only emerges when borrowing costs are manageable, credit is available, and central banks are supportive rather than restrictive. In other words, liquidity is improving. And here's where it gets really powerful for risk assets like crypto. When liquidity starts rising meaningfully, it doesn't stay locked in safe havens forever. It begins to move. First, it flows into traditional equities, giving broad stock indexes a lift. Then, it rotates into higher beta areas like small-cap stocks, which are more sensitive to economic growth. From there, it pushes further out the risk curve into alternative assets, growth sectors, and eventually the most volatile corners like cryptocurrencies. We've watched this sequence play out multiple times throughout crypto's history. Strong liquidity environments act like rocket fuel for risk-on markets, turning solid setups into explosive moves. This particular PMI flip feels especially significant because it dovetails so precisely with the extended cycle thesis that many macro-focused analysts have been discussing for months. The core idea is that the usual 4-year pattern we've seen in crypto bull markets got stretched this time due to unusual debt dynamics coming out of the pandemic. When interest rates were near zero, businesses and governments around the world refinanced massive amounts of debt, locking in low rates and extending maturities far beyond the historical average. Instead of the typical 4-year rollover cycle, we ended up closer to 5.4 years. That pushed back the massive wave of debt refinancing and the accompanying liquidity injections needed to keep markets functioning smoothly into 2026 and beyond. Analysts have been estimating that trillions upon trillions of dollars in debt will need to be rolled over this year and next, forcing central banks and policymakers to provide substantial support to avoid disruptions. Some projections put the total liquidity injection required just to cover interest payments and refinancings in the $8 to $10 trillion range globally. When that kind of money enters the system, it has to go somewhere. And historically, a meaningful portion eventually finds its way into risk assets. Today's PMI surge is like the first visible ripple from that incoming wave. It's tangible evidence that the real economy is starting to respond to improving financial conditions right on schedule. Manufacturing managers aren't making optimistic reports because they're feeling hopeful. They're doing it because they're seeing actual orders increase and production demands rise. That's the kind of organic growth signal that confirms the liquidity backdrop is shifting in a sustained way. If you pull back and look at the historical record, the consistency is striking. Every single time the ISM manufacturing PMI has moved convincingly into expansion territory after a prolonged contraction, stretching all the way back to Bitcoin's earliest trading days, the broader crypto market has eventually embarked on a major upward leg. There are literally no counterexamples. Of course, the move doesn't happen overnight. Markets need time to price in the new reality, for positioning to adjust, for sentiment to catch up. But once the liquidity trend is established, the path of least resistance for risk assets tilts decisively higher. What's fascinating about this cycle is how unusual it's already been. For the first time ever, Bitcoin and major cryptos managed to push to new all-time highs, while manufacturing was still deep in contraction territory. That speaks to the unique drivers at play: technological adoption, institutional infrastructure build-out, and regional liquidity differences. But it also explains why the moves felt somewhat constrained compared to past cycles. We got upside, but not the full-blown across-the-board explosion many were expecting. Now, with the foundational economic indicator finally turning, it opens the door for the kind of broad-based rally that brings in fresh capital from the sidelines. Other supporting signals are falling into place as well. Look at commodity markets, for instance. While precious metals like gold and silver have experienced sharp corrections after their recent parabolic runs, industrial metals have shown remarkable resilience. Copper in particular has held up far better than the precious complex. That's meaningful because copper is embedded in virtually every aspect of manufacturing and infrastructure: wiring, electronics, construction, renewable energy equipment, you name it. When copper demand stays firm, even as speculative fervor cools elsewhere, it suggests genuine industrial usage is driving prices, not just hot money. That directly corroborates the expansion signal from today's PMI report. At the same time, small-cap equities have been outperforming early this year in a way that often precedes wider risk rotations. When the Russell 2000 and similar indexes start leading the charge, it's typically because investors are betting on economic growth benefiting smaller, more cyclical companies. Historically, strong small-cap leadership has been a precursor to altcoin seasons and broader crypto outperformance, usually with a lag of several months as liquidity continues to spread outward. Now, let's zoom in on XRP specifically, because the timing of this macro shift feels almost tailor-made for where XRP sits in the ecosystem. As I'm recording this on February 2nd, 2026, XRP is trading around $162, steadfastly respecting major support zones, even as the overall market works through recent consolidation. Just yesterday, on February 1st, Ripple carried out its routine monthly escrow release, unlocking 1 billion XRP across several program tranches from known wallets. This has been happening like clockwork for years. It's not a surprise event, not a dump, but a deliberate, transparent mechanism designed to provide controlled liquidity for ecosystem development. In practice, a significant portion of those released tokens, typically 600 to 800 million, gets relocked into new escrow contracts shortly afterward, while the remainder funds operational needs, partnerships, and market-making activities. The key observation from long-term watchers is that when price remains stable or even absorbs these releases without major downside, it's often a sign of underlying demand strength. Quiet accumulation by larger players can offset scheduled supply events, and that's exactly the kind of steady behavior we've seen recently. What sets XRP apart in an environment where liquidity is starting to flow more freely is how its core design aligns with institutional needs rather than retail speculation cycles. The total supply is kept at 100 billion tokens, with no additional minting possible. Every single transaction on the network burns a tiny fraction of XRP as an anti-PAM measure, creating a subtle but real deflationary pressure that grows more meaningful as usage scales. The escrow system itself adds a layer of predictability and transparency that's rare in this space. There's no hidden inflation, no surprise unlocks, just scheduled, auditable releases that the market has learned to price in. But the real differentiator is utility. XRP was built from the ground up to solve concrete problems in global payments, specifically the massive inefficiencies in cross-border settlement that still plague traditional systems. Trillions of dollars move across borders every year, often taking days to clear, while tying up capital in nostro-vestro accounts and incurring high fees. Ripple's focus has always been on providing faster, cheaper, more reliable rails for those flows, positioning XRP as an efficient bridge asset. That vision continues to gain traction in regions where payment friction remains acute. Asia, the Middle East, Africa, Latin America, partnerships and pilot programs keep expanding, integrating with banks, remittance providers, payment processors, and even central bank digital currency initiatives. Recent developments such as deeper integrations with major enterprise technology providers are bringing blockchain-based settlement capabilities to hundreds of millions of existing banking customers. These aren't flashy announcements. They're methodical, behind-the-scenes advancements that build real infrastructure. When global liquidity improves and institutions have more capital to deploy, they don't typically chase short-term hype. They look for tools that reduce operational costs, improve balance sheet efficiency, and comply with evolving regulatory standards. XRP's combination of speed, settlements in seconds, low transaction fees, proven scalability, and increasing regulatory clarity checks those boxes in a way few alternatives do. The multi-year legal battles that created so much uncertainty have largely resolved, lifting what was essentially a discount applied to the asset due to perceived risk. With that overhang fading and macro conditions turning supportive, the setup for revaluation based on actual usage becomes much clearer. Think about the connection chain. Rising liquidity encourages economic expansion. Businesses and banks seek efficiency gains. Cross-border payment volume increases. Demand grows for fast, low-cost settlement rails. Networks like the XRP ledger see higher real-world throughput. The native asset benefits from both transactional demand and deflationary mechanics. It's not speculation. It's a logical progression that becomes more probable when the broader financial environment is accommodative. Of course, markets never move in straight lines. We've all experienced the frustration of short-term volatility, the waves of fear, uncertainty, doubt that seem engineered to test conviction. Sideways price action can feel endless. Scheduled supply events get misinterpreted as bearish. Daily chart wiggles dominate headlines, while bigger trends build quietly. It's easy to get discouraged, to wonder if the waiting will ever end. But that's precisely how major shifts often develop. The strongest moves frequently come after periods of maximum exhaustion. When sentiment is at its most pessimistic, when most participants have capitulated or grown numb to the chop, accumulation happens in the shadows while attention is elsewhere. Today's PMI report, arriving after the longest manufacturing contraction ever recorded, feels like the moment when the broader economy finally starts validating the technological progress we've been watching in blockchain for years. Consider the layers aligning right now. Decisive manufacturing expansion after years of drag. Surging new orders, indicating sustained momentum. Improving liquidity backdrop, just as massive debt rollovers approach. Industrial commodity resilience, confirming real demand. Small cap leadership, signaling rotation into growth areas, and XRP maintaining structural support while continuing to build institutional bridges. It's a convergence of signals that long-term observers rarely see all at once. I'm not here to promise explosive gains tomorrow or paint an unrealistic picture. Markets can remain irrational far longer than any of us find comfortable, and unexpected twists are always possible. But when you step back and honestly assess the evidence, the concrete economic data released today, the extended liquidity thesis playing out on schedule, XRP's unique positioning for institutional adoption, and the unbroken historical precedent linking manufacturing expansion to crypto bulls, it's extraordinarily difficult not to feel genuine optimism about the trajectory ahead. This is why I keep coming back to these topics, watching how macro currents, technological development, on-chain evolution, and real-world adoption gradually converge into something powerful. It's never about quick riches or overnight moonshots. It's about recognizing larger patterns, staying informed through the inevitable turbulence, and maintaining perspective when short-term noise dominates. What do you all think about today's manufacturing surprise? Does it change your view on the timeline for broader crypto moves? Are you seeing the same connections between liquidity, industrial strength, and assets like XRP? How are you interpreting the recent escrow absorption and price resilience? Share your thoughts below. I read every single comment and genuinely appreciate hearing different perspectives from this community. If you found this breakdown helpful for cutting through the daily chaos, drop a like and consider subscribing so you don't miss the next update as developments keep unfolding. Until next time, stay patient, stay curious, and keep focusing on those bigger trends shaping the future. Days like today are powerful reminders of why so many of us remain committed to this space for the long haul. Talk soon, guys.